Hello and welcome to this video on the economics of Bitcoin. Bitcoin is a digital currency that has gained significant attention and popularity in recent years, with its value soaring to unprecedented levels. But what is Bitcoin and why has it become so important in the world of economics? Bitcoin was created in 2009 by an anonymous individual or group of individuals using the pseudonym Satoshi Nakamoto. It operates on a decentralized system, meaning it is not controlled by any central authority such as a government or financial institution. Instead, it uses a peer-to-peer network to verify and process transactions. Bitcoin has several unique characteristics that make it an interesting subject for economists to study. It has a limited supply, with only 21 million bitcoins that can ever exist, and its distribution is also unique. Bitcoin's price can be highly volatile, making it a popular target for investors and traders. Understanding the economics of Bitcoin is important for anyone who wants to invest in or use this digital currency. In this video, we will explore the basic economic concepts that underpin Bitcoin, as well as its supply and distribution, price and volatility, and potential uses as a store of value and currency. We will also discuss some of the risks and challenges associated with Bitcoin, such as security and regulatory risks. So, let's dive into the economics of Bitcoin and explore this fascinating topic in more detail. Bitcoin is a complex digital currency that operates on a decentralized system. To understand how it works, it's important to first grasp some basic economic concepts that are relevant to Bitcoin. Here are a few key concepts to keep in mind. 1. Scarcity and limited supply. One of the key features of Bitcoin is its limited supply. Unlike fiat currencies, such as the US dollar or euro, which can be printed and created at will by central banks, there is a fixed limit on the total number of bitcoins that can ever exist, 21 million. This limited supply creates a sense of scarcity and can affect the value of Bitcoin. 2. Supply and demand. Like any other currency or asset, the value of Bitcoin is affected by supply and demand. When there is high demand for Bitcoin and limited supply, the price will increase. Conversely, when demand is low and supply is high, the price will decrease. 3. Market dynamics. Bitcoin operates on a decentralized network of computers that validate transactions and add them to a public ledger known as the blockchain. This means that the market for Bitcoin is decentralized, with no single entity controlling the market. The market is instead made up of individuals and organizations who buy and sell Bitcoin. 4. Speculation. Bitcoin is often subject to high levels of speculation, meaning that people buy and sell it in the hope of making a profit. This can lead to volatile price movements, with the value of Bitcoin often rising and falling rapidly. Understanding these basic economic concepts is essential to understanding the mechanics of Bitcoin. Bitcoin is a unique currency in that its supply and distribution are predetermined and controlled by its underlying code. There will only ever be 21 million Bitcoins in existence, with the final Bitcoin expected to be mined in 2140. Understanding how this supply is created and distributed is essential to understanding the economics of Bitcoin. 1. The mining process. The process of creating new Bitcoins is called mining. This involves solving complex mathematical problems to validate and add transactions to the blockchain, and in return, the miner receives a reward in the form of new Bitcoins. The reward for mining Bitcoin is halved approximately every 4 years, with the current reward at 6.25 Bitcoins per block mined. 2. The total number of Bitcoins. The total number of Bitcoins that will ever exist is limited to 21 million. This is built into the underlying code of Bitcoin and cannot be changed without a consensus from the network. The limited supply of Bitcoin is one of its most significant features and is often cited as a reason for its potential value as a store of value. 3. Bitcoin distribution and ownership. Bitcoin distribution is uneven, with some individuals and organizations owning large amounts of the total supply. The top 1% of Bitcoin holders own more than 90% of the total Bitcoin supply. This can lead to concerns about centralization and the potential for manipulation in the market. 4. Lost and inactive coins. One of the unique aspects of Bitcoin is that it is a decentralized currency that is entirely self-contained. This means that there is no central authority to recover lost or inactive coins. Estimates suggest that as much as 20% of the total Bitcoin supply may be lost or inactive, which can have an impact on the market and supply of Bitcoin. The limited supply and decentralized nature of Bitcoin are key features that contribute to its perceived value as a potential store of value. Bitcoin's price is highly volatile, with frequent price movements of several percentage points in a single day. This volatility can be both a blessing and a curse for those who invest in Bitcoin. Understanding the drivers of Bitcoin's price movements is essential for investors and traders to make informed decisions about their investments. Here are some key factors that contribute to Bitcoin's price and volatility. 1. Supply and demand. As we discussed earlier, the supply of Bitcoin is limited to 21 million, and the demand for Bitcoin is driven by various factors, including interest from institutional investors, market speculation, and adoption by merchants and consumers. When demand for Bitcoin is high and the supply is limited, the price will increase. Conversely, when demand is low and supply is high, the price will decrease. 2. Investor sentiment. Bitcoin is often subject to high levels of speculation, which can lead to emotional reactions to news and events. News that suggests increased adoption or use of Bitcoin can lead to a surge in demand and price. Negative news, such as regulation or security breaches, can have the opposite effect. 3. Market dynamics. Bitcoin operates on a decentralized market, with no central authority controlling the price or trading. This means that the market is highly influenced by the actions of individual investors and traders, as well as larger institutional investors. Large orders and trades can impact the market significantly and contribute to price volatility. 4. Network effects. Bitcoin's value is also driven by network effects, which means that the more people use and adopt Bitcoin, the more valuable it becomes. This effect is known as the network effect, and it can be a self-reinforcing cycle that drives up the price of Bitcoin. 5. Competition and innovation. Bitcoin is not the only cryptocurrency in the market, and there are various other digital currencies that offer similar or different features. The competition and innovation in the market can impact the demand for Bitcoin and its price. Despite the volatility, Bitcoin has seen significant growth over the years, with its price reaching an all-time high of nearly $65,000 in April 2021. However, this growth has been accompanied by significant price corrections, with the price dropping by more than 50% at times. The volatility of Bitcoin's price can make it a challenging investment for many investors. However, for those who believe in the long-term potential of Bitcoin, the price fluctuations may be seen as an opportunity to buy in at lower prices. Bitcoin's potential as a store of value and currency has been a hotly debated topic among economists, investors, and the general public. Here, we'll explore the various factors that contribute to Bitcoin's potential as a store of value and currency. 1. Store of value. A store of value is an asset that can retain its purchasing power over time. Gold and other precious metals have historically been used as stores of value, but Bitcoin has emerged as a potential alternative. One of the key features of Bitcoin that makes it a potential store of value is its limited supply, which cannot be increased without a consensus from the network. This means that the total supply of Bitcoin is fixed, and its value may appreciate over time as demand increases. 2. Currency. Bitcoin was originally designed to be a peer-to-peer electronic cash system, allowing individuals to make transactions without the need for intermediaries such as banks or financial institutions. However, Bitcoin's high volatility and low transaction speed have made it a less than ideal medium of exchange. Nevertheless, there are various potential benefits of using Bitcoin as a currency, including increased financial inclusion, reduced transaction fees, and increased security and privacy. 3. Inflation hedge. One of the primary concerns of investors is the potential for inflation to erode the value of their investments over time. Bitcoin's limited supply makes it a potential hedge against inflation, as its value may appreciate over time as demand increases. This feature has made it an attractive investment for those seeking to protect their wealth from the effects of inflation. 4. Adoption and regulation. The adoption and regulation of Bitcoin are essential factors in its potential as a store of value and currency. Increased adoption by merchants and consumers could lead to increased demand and value for Bitcoin, while regulation could provide increased legitimacy and stability to the market. 5. Security and accessibility. The security and accessibility of Bitcoin are also critical factors in its potential as a store of value and currency. The security of Bitcoin is provided by the underlying blockchain technology, which makes it nearly impossible to alter or manipulate transaction records. Additionally, accessibility to Bitcoin is constantly improving, with the availability of Bitcoin wallets and exchanges making it easier for individuals to buy, hold, and sell Bitcoin. Despite the potential benefits, there are also significant risks associated with investing in Bitcoin. its high volatility and lack of regulation can lead to significant price swings and potential losses for investors. Additionally, the potential for fraud and hacking can make Bitcoin a risky investment for those who are not familiar with the technology. Bitcoin's potential as a store of value and currency is still being debated, and its future remains uncertain. However, its unique features, such as its limited supply, potential inflation hedge, and the security provided by the blockchain, have made it an attractive investment for many. As adoption and regulation continue to evolve, the potential for Bitcoin as a store of value and currency may become clearer. While Bitcoin has been touted as a revolutionary technology, there are also significant risks and challenges associated with its use and adoption. Here, we'll explore some of the most significant risks and challenges of Bitcoin. 1. Volatility. One of the most significant risks associated with Bitcoin is its volatility. The price of Bitcoin has fluctuated widely in the past, with significant price swings in both directions. These price swings can lead to significant losses for investors and can make it difficult for businesses to accept Bitcoin as payment. The high volatility of Bitcoin is primarily due to the lack of stability in the underlying market, the lack of regulation, and the limited adoption of Bitcoin as a currency. 2. Security. Another significant risk associated with Bitcoin is security. While the blockchain technology that underlies Bitcoin is generally considered to be secure, there have been numerous high-profile hacks and thefts of Bitcoin. These security breaches can lead to significant losses for individuals and businesses that hold Bitcoin, and they can also erode trust in the technology. 3. Regulation. The lack of regulation is another significant challenge for Bitcoin. While some countries have adopted a regulatory framework for Bitcoin, others have not. The lack of regulation can lead to uncertainty and risk for businesses and investors, as well as the potential for illegal activities such as money laundering and fraud. 4. Adoption. The adoption of Bitcoin as a currency is another challenge for the technology. While the number of businesses accepting Bitcoin as payment has increased in recent years, it is still not widely adopted. The limited adoption of Bitcoin makes it difficult for individuals to use it as a currency and can limit its potential as a store of value. 5. Environmental impact. Bitcoin mining. The process of verifying transactions and adding them to the blockchain requires significant amounts of energy. This energy usage has led to concerns about the environmental impact of Bitcoin mining, as well as concerns about the sustainability of the technology. 6. Scalability. Another challenge for Bitcoin is scalability. The blockchain technology that underlies Bitcoin is limited in its ability to process transactions, which can lead to slow transaction times and high fees during periods of high demand. This limited scalability can make it difficult for Bitcoin to be adopted as a mainstream currency. 7. Competition. Bitcoin faces competition from other cryptocurrencies, some of which may offer advantages over Bitcoin such as faster transaction times, lower fees, and improved scalability. As the market for cryptocurrencies continues to evolve, Bitcoin may face increasing competition from other digital currencies. While Bitcoin offers many potential benefits, there are also significant risks and challenges associated with its use and adoption. The high volatility, security risks, lack of regulation, limited adoption, environmental impact, scalability issues, and competition are just a few of the challenges facing Bitcoin. As the market for cryptocurrencies continues to evolve, it is essential to carefully consider these risks and challenges before investing in or adopting Bitcoin. The economics of Bitcoin is a fascinating and complex subject that has generated a great deal of interest and debate in recent years. Bitcoin represents a unique form of money that is decentralized, borderless, and digital, which has led many to view it as a potential disruptor of traditional financial systems and a harbinger of a new era in economics. However, as we have explored in this video, there are significant risks and challenges associated with Bitcoin, such as its high volatility, security risks, lack of regulation, limited adoption, environmental impact, scalability issues, and competition from other digital currencies. These challenges must be carefully considered by anyone seeking to invest in or adopt Bitcoin, as they have the potential to impact the future value and usefulness of the technology. Nonetheless, despite these challenges, the economics of Bitcoin continue to evolve and develop. As the technology matures and gains wider adoption, we may see new use cases emerge and new benefits unlocked, such as greater financial inclusion, reduced transaction costs, and increased privacy and security. Ultimately, the economics of Bitcoin is a subject that warrants ongoing study and exploration, as it represents a significant shift in the way we think about money and finance. By understanding the basic economic concepts, the supply and distribution of Bitcoin, its price and volatility, its potential as a store of value and currency, and the risks and challenges associated with the technology, we can gain a better understanding of its potential impact on our economy and our world. Thank you for watching this video on the economics of Bitcoin. We hope that it has provided you with a comprehensive understanding of the subject and has given you some insights into the potential benefits and challenges associated with this revolutionary technology. If you found this video informative and useful, please consider giving it a thumbs up and subscribing to our channel for more content on economics, finance, and technology. And if you have any comments or questions about the economics of Bitcoin, feel free to leave them in the comment section below. We'd love to hear from you. Until next time, thank you for watching, and we'll see you in the next video.